Thinking about diving into stock trading but worried about making costly mistakes? You're not alone. Many beginners jump in with excitement but quickly stumble into common traps that can drain your money and confidence. In this video, we'll break down the 5 most common pitfalls new traders face and how to avoid them. Whether you're just starting out or looking to sharpen your skills, these tips will help you trade smarter and protect your investment from day one. Today we will talk about stock trading for beginners. Avoid these 5 common pitfalls. So before we start, make sure to hit the like button and subscribe to my channel. 1. Lack of proper education and preparation. One of the most critical mistakes beginners make in stock trading is jumping into the market without sufficient education and preparation. Trading stocks involves understanding complex concepts such as market mechanics, order types, and the factors influencing price movements. Without this foundation, beginners risk making uninformed decisions driven by speculation or hearsay. Before placing a single trade, it's essential to learn the difference between trading and investing, the workings of stock exchanges like the NYSE and NASDAQ, and how economic indicators impact markets. Utilizing paper trading platforms or simulators can help beginners practice strategies risk-free, fostering confidence without financial loss. Moreover, grasping essential terms like bid-ask spread, liquidity, volume, and volatility enables traders to better navigate market conditions. Understanding how to read charts, interpret candlestick patterns, and use basic technical indicators such as moving averages or RSI will improve timing and decision-making. Likewise, knowledge of fundamental analysis, studying company earnings, revenue, debt levels, and industry trends, helps evaluate whether a stock is fundamentally sound or overhyped. Failing to prepare properly often results in costly mistakes fueled by emotion rather than logic. Education also includes recognizing the psychological challenges of trading. Fear, greed, and impatience frequently cloud judgment. Beginner traders should set realistic expectations, acknowledging that losses are part of the learning process and that consistent profits require discipline and ongoing study. In short, investing time in education and preparation lays the groundwork for informed, confident trading and reduces the likelihood of costly errors. 2. Letting emotions control your trades. Emotional decision-making is arguably the most dangerous pitfall for new traders. The stock market's volatility can trigger strong feelings such as fear, greed, anxiety, and hope, which often lead to impulsive actions like panic selling during a dip or chasing a rapidly rising stock. Fear of loss can cause premature exits, locking in small losses, and missing potential recoveries, while greed may compel holding on to winning positions for too long, risking a reversal. Successful trading requires strict emotional discipline and a rational mindset. One way to mitigate emotional trading is to develop and strictly follow a trading plan that includes entry and exit points, stop-loss orders, and profit targets. This removes guesswork and limits impulsive decisions. Stop-loss orders are crucial because they automatically close positions to cap losses before emotions take over. Additionally, risk management reduces emotional pressure. By risking only a small portion of capital per trade, typically 1 to 2%, traders minimize the psychological impact of losses. Maintaining a trading journal also helps track emotional patterns and mistakes, allowing self-reflection and improvement. Over time, traders develop patience and detachment, learning to accept losses as normal rather than catastrophic. Remember, consistent profits come from logical, disciplined execution, not chasing the market's highs and lows driven by emotion. 3. Ignoring risk management principles. Neglecting risk management is a common and costly beginner mistake. Many novice traders focus solely on potential profits without adequately considering how much they could lose. This imbalance leads to oversized positions, lack of stop-loss usage, and excessive leverage, all of which can quickly decimate a trading account. Proper risk management is the bedrock of long-term trading success. It starts with position sizing, limiting how much capital you allocate to any single trade, generally not exceeding 1 to 2% of your portfolio. This approach ensures that even multiple losing trades won't wipe you out. Coupled with this is the critical practice of placing stop-loss orders at a level that respects market volatility but limits downside risk. Leverage amplifies both gains and losses. While margin can boost profits, it also magnifies losses, often faster than beginners anticipate. Understanding margin requirements in trading with limited or no leverage reduces the risk of catastrophic losses. Beginners should avoid high-leverage products until they fully understand the risks. Diversification is another risk control method. Avoid concentrating your portfolio in one stock, sector, or market. Spreading investments across industries and asset classes smooths out volatility and reduces exposure to idiosyncratic risks. Ultimately, consistent application of risk management techniques ensures survival in the market and provides the opportunity to grow capital steadily over time. 4. Overtrading and chasing the market. Overtrading is a frequent mistake among new traders who feel the need to constantly buy or sell to make profits. This behavior often stems from impatience, boredom, or the misconception that more trades equal more chances to win. However, excessive trading increases transaction costs, exposes the trader to unnecessary risk, and can lead to poor decision-making. Chasing the market is closely related and involves buying stocks after sharp price increases or selling after sudden drops, hoping to catch the next big move. This reactive trading ignores analysis and often results in buying high and selling low, the opposite of a successful strategy. Effective trading involves patience and discipline, waiting for setups that meet strict criteria based on research and analysis, rather than acting on every tip or rumor improves success rates. It's important to remember that not every day will have good trading opportunities, and waiting for the right moment is part of the process. Using limit orders instead of market orders helps control entry prices, preventing impulsive purchases at inflated prices. Additionally, setting daily or weekly trade limits can reduce the temptation to overtrade. Beginners should focus on quality over quantity, recognizing that well-planned trades usually outperform a high volume of impulsive trades. 5. Neglecting continuous learning and adaptation. The stock market is dynamic, constantly influenced by new information, economic shifts, technological advancements, and changing regulations. A major pitfall for beginners is assuming that a strategy that worked once will always work. Stagnation in learning and failure to adapt can lead to poor results as market conditions evolve. Successful traders commit to lifelong learning. This includes studying market news daily, reading financial reports, analyzing past trades, and staying updated on new tools and strategies. The market's complexity requires traders to adapt to new trends, such as the rise of algorithmic trading or changes in market structure. Keeping a detailed trading journal is invaluable for continuous improvement. Recording trades, emotions, mistakes, and outcomes helps identify patterns and refine strategies. Learning from losses and successes builds experience and resilience. Additionally, joining trading communities, attending webinars, or taking advanced courses expands knowledge and offers fresh perspectives. Staying humble and open-minded prevents overconfidence, which is a dangerous mindset for any trader. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.